Hello, this is Nicole. I hope you guys are doing well. It is another bullish day in the markets. Holy smokes. This market is definitely on fire. And there are a lot of positions that are up tremendously over the course of the last few trading sessions. I'm fortunate to have a few positions in a few of these types of securities, one of which is OKLO. I was fortunate enough to purchase 100 shares of OKLO a few months ago at a trade price of just over $49. And we can see here by taking a look at the chart, OKLO has really appreciated in price tremendously over the course of the last week or so, especially over the course of the last, 3 trading sessions. And with that has come a dramatic spike in implied volatility. So you can see here that implied volatility in the blue is trading up near 60%. And when we look back over the course of the last year, we can see that implied volatility was trading at these levels previously. So we're kind of back into the middle of the range here with this. And let me go back to the monitor tab. And we can see that I am sitting on an unrealized gain of 185%, which totals for me a little over $9,000. So I can guarantee you not all my trades look like this, but I'll tell you what, when you have positions that do this well, you need to do things to protect your profits. Okay, because this market is a little bit unusual. Okay, so let's head over to the trade tab and take a look at what I can do here to take advantage of some of this implied volatility. First, I'm going to take a look at the options expiry implied volatility. So this takes the different options expirations and just kind of tells me what those options are doing from a implied volatility standpoint. And you can see here that the implied volatility isn't that different. We're getting some higher values here in these shorter duration expirations. And given what's happening, that's not too much of a surprise. Okay, but overall, nothing crazy is happening here as far as one expiration standing out from the other. Of course, these implied volatilities are very heightened, so that part might look a little crazy to you guys. But as far as one expiration sticking out compared to the other, I'm not seeing anything dramatic. Okay, so let's take a look at the October 17th, 2025 options expiration cycle. These options expire in 25 days. And I want to take a look at implied volatility here on the call side. And this is a little unusual for equity options in that implied volatility is actually going up as the strike price goes up. And that's unusual. Normally, implied volatility goes down as the strike price goes up because we're usually looking at put skew. The risk of a swift downward move is higher in the eyes of the options market relative to an up move. Now, in this case, that is not happening. Okay, so, I have 100 shares and I am long-term bullish on this OKLO. It's a very speculative play. I have a very small position in it, but I am sitting on those gains and it would be a bummer to see those just kind of dissipate if the market did an about face and, corrected down as swiftly as it went up. So let's say that I am interested in possibly selling the 200 strike call option, and that's as high as I can go. I can't go higher. They aren't listing options in this expiration higher than 200. And this particular call option is trading at an implied volatility of 145%. So if I were to sell this call option, the worst possible credit I could receive is $5.60. Now, I want to turn around and see if I can purchase a put option to enter into a cashless collar trade, with the whole point being to protect my downside and kind of lock in gains. So I'm going to scroll down on the put side here, and we can see that implied volatility on the put side is actually going down a little bit as you get further out of the money. So there's definitely call skew in these options. Okay, so I'm going to scroll down and I'm looking to purchase a put somewhere around $5.60. And the 110 strike put option fits the bill here. It's not exact, but it's pretty close. So if I go ahead and populate purchasing the 110 strike put, we can see here that I could put on that collar trade for an 8-cent debit. Okay, and that would give me protection to the downside below $110 per share, but it would cap my gains above $200 per share. So I need to ask myself, is that worth it for me? And if on October 17th, 2025, OKLO is trading above 200, this collar position is going to show a loss against my 100 shares. And at that time, I would have to decide, do I buy back the collar, okay, for a loss and allow my shares to continue to run? Or do I just let the position get called away and be thrilled with the amount of money I just made on a very small trade? I don't know. I'll tell you what, this position is very small for me, and I entered into it with the mindset that this was going to be a buy and hold for the long term. If I owned 200 shares of OKLO, I'll tell you what I would be doing. I would probably be looking at selling a closer to the money call option, maybe the 170 against one of the 200 shares, 100 of the 200 shares that I would theoretically own in this scenario. And I would turn around and I would look at probably buying 2 of the 110 puts. And that's a trade structure that I've done before in scenarios like this. And so hypothetically, if I own 200 shares of OKLO, I would probably, well, that would give me some flexibility. So in a scenario like this, if I owned 200 shares of OKLO or more, entering into a structure like this would give me quite a bit of flexibility in terms of how to manage the position. So I just wanted to hop on and illustrate this as an example. We don't see this kind of stuff that often. It's a great learning tool, and I hope you guys are really doing well in this market and that you're able to participate in some of these moves in a beneficial way. Happy to have you here, and I hope you're all doing well. Thanks for watching. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, cost, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions may change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.